is there a scenario in which the market is going to like that U.S. inflation is going up for the first time in 13 months? This would be the question that we ask ourselves today on Macro Money. Welcome to the show. This is Ilya Spivak, head of Global Macro here at tastylive. And the answer probably will not be that surprising, but the dynamics for what could happen if inflation actually goes the other way and disappoints, that may be a bit of something that is new. And what we're going to be watching here most closely is why that is and what's been going on here. We're going to break down what the numbers are expected to be, how the markets might respond in that scenario, and from there, consider, would the markets like an upside surprise? That seems unlikely. Would they like a downside surprise? Well, they've liked one before, but something may be different, or so it seems. So let's unpack what's going on here. We begin with just a look at the bare bones basics here. So this is the trajectory for US CPI. We can see here the headline number there in the solid red line, the core in the dashed red line, and then the components. And of course, this is not a story that we should be unfamiliar with. We have a situation where services, excluding food and energy, remain the bulk of the inflation story. It was about half and half, goods and services, when we started the process of tightening in early 2022, the Fed launching that cycle in March. We can see that the goods part has been squeezed to next to nothing. Energy is now, despite the recent gains, and we'll see if this continues to be the case, but as of the last set of numbers, energy has actually been a disinflationary force. It's been pulling inflation lower. That's that yellow bit on the bottom there below zero. The goods part essentially worked out as Fed rate hikes slowed global economic activity, and also because a lot of the post-COVID supply chain issues that were still there have found their way to being worked out. Shipping costs are back down to pre-pandemic levels. The cost of moving goods around the economy, as we just saw in the latest producer price index report, those are back down, and in the case of intermediate goods, they're actually shrinking. So not surprising that goods have really fallen out of this equation to a large extent. Food inflation is still a bit of a thing, but clearly its contribution there completely dwarfed by what's going on the service side of things, and most of that seems to be labor. There's still about a, let's call it a 3 to 5 million shortage between labor supply and demand, and that seems to still be bidding up wages. We saw that in the latest NFP report, the employment report that we just got last Friday. Wage inflation surprised meaningfully on the upside, 4.4% versus 4.2% year on year expected. That sort of speaks to what this is. This is the lens through which we're looking at this. This is the Fed's lens, because, of course, it's the Fed's lens that's going to really alter why this is going to move markets or not. Will it change the Fed's calculus? And I've said this endlessly here on Macro Money, it's the Fed's calculus that is most important, because what the Fed is doing is manipulating up and down the cost of money, which is, of course, exactly what their job is. They're out here making the kind of decisions that make investors say whether they should be deploying capital at all. Only after that part of the conversation do you get into, oh, I should be buying something that's in this sector versus that sector, this asset class versus that asset class. Before you make any of those decisions, You first have to make the decision, do I want to put money at risk in any way on anything? And that's something that extends beyond investing clearly to businesses that say, I want to expand capacity or hire more workers, or I don't, to individuals that say, I want to buy a new washing machine / car / whatever it is, or I don't. So the Fed, in that it will have a reaction function to this data that at the very least gradually or relatively shifts the equation on the cost of money, that's the lens that is the market moving lens for how this data might be digested. And so in that sense, it is that service sector number that we're going to be looking at here. This is what the calculus looks like. If we look at how U.S. economic data has been performing in recent weeks, then going all the way back to about mid-May, we can see that there's an upturn. This is data from Citigroup showing how U.S. economic outcomes have generally performed against baseline expectations. Those baseline forecasts compounded from a whole sea of market-watching economists and analysts that are typically polled by the likes of Reuters, Bloomberg, et cetera. And what we see then here is their forecasts have been more soft than reality has endorsed. So outcomes have been tending better and by an increasing margin, hence the index going up. So that seems to paint a picture of a generally more robust economy, at least for now, and also a generally stronger pull on inflation. Generally, economic growth and inflation go hand in hand. If the economy is doing relatively better, then inflation tends to get a boost just because more money changing hands tends to be inflationary. So what we have then here is perhaps scope for an upside surprise. A bit of a preview on this emerged in the last ISM report, in particular the services prices index, that's there in the orange, but you can see manufacturing also ticked up a little bit in that survey. This is the prices subcomponent of that survey. And as ever, what we're talking about is in the logic of PMI numbers. So 50 is the center line, above 50 is growth, and below 50 is contraction. So you can see that in the case of manufacturing, we're still in contraction on the price structure there, still under 50, but in moving from a lower under 50 to a higher under 50 reading, in seeing that number go up, we see that the decline in prices on the manufacturing side slowed some. It's a different story for services, and of course, services is overwhelmingly where the problem is, as we've just discussed. It is also by far the largest sector of the economy. So there you see we're above 50, so prices are growing. They had been decelerating, much as CPI has been, and now they've ticked up, suggesting that there was, in fact, a pickup in inflation in July, at least as far as the ISM numbers are concerned. So if we were looking at this and saying there's likely to be an upside surprise, this seems to endorse it. And it seems to endorse it in the area where, from a Fed perspective, it would be the most sensitive. That brings us to the Fed's conundrum with the current environment. We have here inflation expectations from both the swaps market and the bond market over the near term. The bond market is the yellow bars there. That's the 2-year break-even rate, the difference between nominal and inflation-adjusted, or TIPS, yields at the 2-year tenor. And when you take that difference, the residual you're left with is the inflation expectation you need to subtract from nominal rates to get to inflation-adjusted rates. So that gives us the current expectation for inflation over a 2-year window, not somebody's forecast, but as it is priced into bond markets. You can see it's right on target, 2%. The 1-year swap is at 2.3. So the Fed is quite close to target there within a year's time, but not quite there yet. So what we're seeing here is essentially a situation where everything is priced to perfection. You can see these forward-looking expectations tend to lead CPI by about 2 months. And worryingly for the Fed, they haven't fallen basically since April or so, but have instead been idling. So everything that's occurred in the recent months to actually increase the overall setting of rates, to push out some of the rate cuts that were baked in there around the U.S. debt ceiling debacle may be going wrong and then not. The U.S. Banking crisis may be going wrong and then not. All of the cuts that were linked to those idiosyncratic events going away and the outlook becoming a bit more hawkish, they haven't budged this calculus at all. And what you're left with then is a situation where, if anything at all spooks the process, if oil prices continue to rise as they've been recently, if natural gas prices continue to rise, if there is a food shock, for example, linked to renewed escalation between Russia and Ukraine, and if that finally does start to impact the price of wheat, if the recent ban that India instituted on rice starts to boost food inflation, if all of these things come together and we get a shock, well, there's not really a lot of margin for error. The Fed can get on its target in 2 years' time if virtually nothing happens that takes it off course according to the current setting in financial markets. So if any of these things occur, the Fed goes off course. This is not where they'd like to be. I've mentioned before that for the Fed, the likely ideal is to actually be a little bit under target on these measures, such that the Fed could cut into seeing them rise. That would be a much more comfortable way to land the economy, where to get to target, you'd need to actually stimulate a bit, or at the very least loosen the reins. That's not where we are currently. So if we were to get a CPI number north of the 3.3% expected, because we have an upside surprise, as we've just discussed, well then, these expectations really start to veer the wrong way. Markets ostensibly respond. They have to now readjust their expectations for a CPI number that's different from what they'd penciled into their assumptions. The response from the Fed might well be judged, at the very least, to translate into something that is less stasis, a little bit less dovish, maybe a little bit more hawkish than current expectations. What does that mean? Well, if we look here, we can see at this point, for the remainder of this year, the market expects no change in policy. The blue line there, that's the September meetings expected rate. That's from Fed funds futures, the implied rate. The red one is December. The gray bars is the spread between the two. You can see, by the way, that as you look at the beginning of the year, right around March, you see both of them decline sharply. That's the banking crisis. You then see significant rate cuts being baked in. As recently as May, the markets thought that between September and December, we'd get 50 basis points in cuts. you can see that those are the cuts that have been factored out, as we were just saying. That's a net hawkish shift in policy expectations. You can see here that as we get into July, 50 basis points in expected cuts are gone. And yet, as we just saw here, that did not budge inflation expectations, to the Fed's chagrin, no doubt. So what would a hawkish adjustment mean here? Are we likely to get more hikes that suddenly enter the forecast? Well, it would be one number, so perhaps not immediately. It would probably depend how much of a surprise we got. It seems like the markets have been on this idea that we're not going to get any rate hikes between September and December for quite a while. And it's been a fairly well-established view for a few months now. Let's call it about 2. And so maybe the market doesn't jump all the way that far, but looking at the cumulative odds for where things are currently set up, maybe what happens is at least the odds increase. At this point, we can see that the probability of a September rate hike is priced in at a meager 12%, so essentially not very likely at all. And really, there's not a meaningful probability of an increase from here forward. The highest we can see here is November at 34%. But what a hawkish adjustment could do is change the calculus for when the easing would begin that follows. You can see here right now, that's basically in March. The probability of a cut by January is only 20%. By March, at that meeting, it's 60%, but cumulatively, that's an 80% chance of a cut by March. That's almost certain. The Fed generally has moved when the odds are lower. It's not typically in the business of surprising markets with something completely out of left field. So if the likelihood already in the expectations is that there's an 80% chance for a cut in March, chances are the markets are pretty convinced. And that cut probably occurs if that holds up. But that's if it holds up. If we get a hot CPI number here, it's quite possible that the timing of this turn, which you can see here by May, one cut is fully baked in. And there's about a 47% chance for a further one by then, which you get to June and that second cut is already there. In fact, the rate cut cycle that's implied here is quite steep in the back half of next year. It could be that the timing there then shifts. And maybe the hawkish adjustment that we see on a hot number is just a higher for longer adjustment. Maybe we don't get the hike. But it would be enough to see the easing cycle moderate in the forecast, either by getting pushed out to a later date for the start, or a flattening of how steep that easing cycle is likely to be, maybe even both. The response would be, most likely, unwelcome from stock markets. They wouldn't like to see a higher hurdle rate on economic activity persist for longer. That would be a bigger threat to growth, to consumption, therefore to corporate earnings. Not a good story for stocks. It would probably be more supportive for the US dollar, in that it would burnish the dollar's yield advantage against other currencies. And so, were we to get a sort of straightforward upside surprise, a Fed-minded reading of this would think, well, that's going to be a negative outcome for cyclical and otherwise kind of sentiment-linked assets. It probably means a stronger dollar, weaker most major currencies, probably means higher yields, so maybe weaker bonds, and probably means lower stocks. Where things get interesting is if actually the surprise is in the other direction. And this is where maybe there's been a bit of a regime change in markets. If we take a look here, the yellow bars are the S&P 500. The dashed line there is just a basic 5-day moving average I've put on there to kind of get the sense of overall direction a little bit cleaner. And then there's those same policy expectations. What's been getting really interesting here is this bit where nothing has changed as far as rate expectations. You can see here that stocks were able to rise even as these things recovered, largely because it seems like risk was going away. So we were getting away from the kind of thing that was essentially saying, look, if this debt ceiling thing goes wrong, there's got to be a lot of cuts. If the banking crisis continues, there's got to be a lot of cuts. That's this decline you see here. Before the banking crisis, of course, the market was, as you might expect, not liking for the Fed outlook to get more hawkish. Stocks were falling as the outlook was getting more in the direction of higher rates. Once we got through this readjustment, things seemingly stabilized, but what's occurring now is without a more hawkish shift in policy expectations, stocks seem to be drifting lower. What's more, the dollar is going higher under the same circumstances. So you haven't been needing a more hawkish Fed outlook to get the dollar to see some meaningful gains. The green line there, again, the moving average and the bars are the dollar as an average index. This is the trade-weighted index, so it's a little bit more representative of the dollar's average value than the DXY US dollar index, which might as well be the euro upside down. That basket was created before there was a euro, and a lot of the currencies in that basket have since become the euro or been folded into the euro. So it's very skewed at this point. This is a little bit more of an equal weighing of the major currencies. And you can see here, we have a dollar that's rising and stocks that are falling without the Fed outlook getting any more hawkish. Well, that starts to raise questions about maybe the market perceives that the back half of this year is going to be much worse for growth than has been the case so far. There is some logic there. The Fed has been saying over and over again that it takes about 12 to 18 months for one single rate hike to be fully absorbed into the economy. Well, consider then the Fed started to hike March of last year. So 12 months is March of this year. 18 months should be right about now, give or take. What you have in that situation then is we should be starting to feel the impact in earnest of those back-to-back 75 basis point wallops that the Fed gave us mid last year. So the impact of that very aggressive tightening should be hitting the economy imminently. No doubt it's a cumulative thing, so it's been building already. But the full weight should be starting to descend upon markets right around now and into the second half of this year. That might be starting to breed growth concerns. Now, this could mean that those rate cut odds that we were just looking at are actually close to being right. Maybe the Fed does need an aggressive rate cut cycle to follow in the first half of next year, because maybe indeed the growth situation starts looking much worse. Well, in that environment, a softer CPI number doesn't look encouraging, doesn't look like the Fed might lighten up on the reins. It looks like those growth concerns are starting to actually manifest. We saw this in spades with Friday's NFP report, where the initial response was, NFP is a bit softer. Risk on. Maybe the Fed doesn't have to do quite so much. Yields lower, the Fed policy outlook a little bit softer. And yet, after a few hours of digestion, the dollar surges and stocks collapse. Because perhaps that softer NFP number isn't bad news being good for sentiment anymore. Because recession risk is more acute, or at least more so on the front mind of investors, given where we are in this cycle. In fact, what's so striking about all of this is, yes, the outlook for the rest of this year has been static, but these gains in the dollar and the turn in stocks, it's happened as we've seen a dovish shift, not just for the odds of a move between now and the end of this year, which were always lower. We can see that in the curve here, but a far more significant flattening from the 6-month mark and thereafter along this implied Fed policy curve. So you can see the dashed line there is where we were at the last FOMC, July of last month. The small dashes are where we were a week ago. And you can see no real meaningful changes from the current setting up to 6 months relative to a week ago in particular. But beyond that, a flattening even there. Never mind since the last FOMC. So the overall outlook on Fed policy has actually grown a bit dovish since the Fed last met. In relative terms, of course. Not in absolute terms. The Fed is anything but dovish. But in relative terms, sure. And even still, the dollar is up and stocks are down in that same period. So a change in the reaction function may be afoot, whereby what the markets want is exactly the Goldilocks number on inflation with very little variability, because that would maintain the precarious status quo that we see here. But if the number is higher, and even if the number is lower, the response from stocks could be anything but positive. Because on the one hand, they would say, well, the Fed needs to do more if this number is higher. At the very least, rates are going to remain higher for longer. That's not good news. But if the number is lower, well, then they might end up saying, if ever there was evidence that things are slowing, a miss here, given everything else that's going on, is worrying, especially in the wake of an NFP number where such a response was already on display. So we're left again with this sense that maybe it's Goldilocks or bust for this CPI number, leaving stock markets uniquely vulnerable, and the dollar perhaps positioned to really manifest that dollar smile dynamic that we like to talk about here, where the dollar gains when things look bad because people are cashing out into the most liquid form of cash, and also gains when things look good for the U.S. economy because that speaks to more scope for a U.S. dollar yield advantage, higher rates. In between those outcomes is a very narrow window. And the likelihood of getting into that narrow window seems relatively small compared to the alternative. So the risk seems to be tilted in the risk-off direction for stocks, for currencies, and by extension for other assets for which these are benchmarks oftentimes, on the other side of this CPI report. And getting to a risk-on scenario seems devilishly difficult. And that is Macro Money for today. Thanks very much for joining me. I am here Monday through Thursday every week, right after Overtime, a show that I do with head of futures and forex here at Tasty Live, Chris Vecchio, where we take the day's events after the Wall Street close and try to make sense of them, and perhaps even figure out where they might be going next. I'm back with Chris on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, writing for the news and insights section of tastylive.com, where incidentally there's a summary of this very conversation now if you wanted the short version, and also opining on Twitter. Yes, Twitter. Thank you very much for joining. Good luck out there. See you tomorrow.